Good morning and welcome to Pareto TV and live from Pareto Securities Energikonferensen. Today we focus on oil companies and shipping. So it will be a busy day, so make sure to follow us on our YouTube channel. Now it's time to talk to Panoro Energy and John Hamilton. A very warm welcome, John.
Thank you.
And also a very warm welcome to you, Tom Erik Christiansen.
Thank you.
Oil and energy analyst here at Pareto. So Panoro Energy is an Africa-based oil E&P company. Tell us more, John.
Sure, no, that's exactly right. We are an Oslo Bourse listed, main board listed African E&P company. We specialize in Africa. That's what we know. We know the rocks there, we know the governments there, we know how things work, and that's where the team's experience is. We have a market capitalization of more than 2 billion kroner. We have about 6,500 shareholders, many of whom, most of whom I would say are Norwegian actually. So we're very, very well established here. We have a very, very strong board, which I think is useful. We have 2 Norwegians on our board, including Torsten Sandnes, who's quite famous in Norway and globally for that matter for his role with the Lundin family. He's our deputy chairman. So we have lots of strong Norwegian links, although we focus on Africa.
And can you take us a bit through kind of what's happened over the last couple of years? Because Panoro used to be a much smaller oil company than what it is today.
We set out a few years ago, myself, the chairman of the company, the board, the small management team, are all people who want to do something. We're deal makers, we come from a deal making background, and we wanted to use the Panoro structure, the excellent structure, the good shareholder base, the Norwegian listing, to try and grow a business. And in oil and gas, it's quite difficult to do that oftentimes. Doing transactions is difficult, but we have set out to do that. And we managed to do that in 2 big movements. A couple of years ago, we bought some assets in Africa, in Tunisia, for about $60 million, which kind of moved us up 1 notch, gave us a lot of credibility towards the industry, towards investors, shareholders, other stakeholders, the ability to transact. And then this year, with Pareto's help, we actually did our biggest transaction yet. We did a transaction which multiplied the size of our company by 4 times. And that was a transaction taking advantage of the market dislocation that we had last year due to COVID and the economic effects, with oil prices dropping down, as everybody knows, to $10 a barrel. But we managed to strike a deal with a seller who needed to sell when oil was about $45 a barrel. These are beautiful assets. We managed to buy them when it was $45 a barrel. And we've managed to do that and enjoying $75 oil at the moment. But through those 2 transactions, we've kind of been able to realize, at least for the moment, our ambition, the ambition of the board, the ambition of the management team to make a bigger company. And we've really managed to do that, I think, quite successfully. It requires patience and time, access to capital, but we've managed to do that now.
Follow-up question there with the oil now going since then basically appreciating 50% to where we are today. Can you talk about some kind of economics of the deal? Kind of how did it look when you bought it? How does it look now? Payback time, those kind of things.
What we did was nobody knows what oil price is going to happen, but we looked at it. We did all our technical analysis of the assets. That's where the analysis starts. And when it comes to plugging in an oil price, we plugged in $45, and long-term we assumed 50. If you assume long-term $30 a barrel, you're never going to win the deal. So we were a little bit ambitious, saying, okay, we'll think $50 long-term. Those assets look beautiful at those oil prices. These were really good deals for us, even if oil was $45 or $50. These are long-term assets. They're going to provide a lot of cash flow for 10, 15, maybe 20 years. These are real hard, good foundation assets for the company. So the economics, basically, for every dollar that goes up, as a rough rule of thumb, we're probably getting half of the benefit of that, so maybe 50 cents on a net post-tax, post-operating cost basis. So for every dollar it goes up, we're taking maybe 50 cents bigger. So we're up $30 a barrel. So it's looking much better. And if oil prices continue where they are, these will have been deal of the century, I think.
And then moving from that and kind of putting that into the portfolio, how does that look production-wise now in terms of growth ahead and where you stand today?
So immediately on day 1, when we finished the transactions, we tripled our production on day 1 when we completed those transactions. So we were able immediately to be 3 times bigger from a production basis, which production of course turns into cash flow, and that's what it's all about. But what's perhaps even more interesting is that these businesses are at the inflection point where we're about to plus or minus double production over the next 18 months. So these are not things that we're hoping to buy and add. These are things that are in the portfolio, wells that are getting drilled, activities that are being undertaken, agreed with partners, agreed with governments, that we're doing these additional activities which should see us plus or minus double our production over the next 18 months. So we've not just bought assets well and tripled the size of our company, but we're actually going to double it again from there.
Sounds good, and of course more production means more cash flow, and then people always ask about the dividend. Panoro has had a firm commitment for a while to start paying dividends in 2023 or by the end of 2023. That was a wording that has been in place for a long time. Now it is maybe changed slightly within 2 years, which seems like there is some potential here. Can you talk about kind of what's happening and why there was a slight change of wording on that?
Absolutely. Now, everybody involved in our business has been around this business for a long time, has seen all the cycles, has seen all the business models, and we are convinced that the sustainable model for an E&P company is the need to return cash to shareholders. Gone are the days where it's just continually money being recycled in the system and shareholders maybe see the share price go up and down. You need a sustainable business model that includes return of cash to shareholders. And that's what we set out to do when we did these transactions. That was the undertaking we gave to our stakeholders, our shareholders, that we were going to return cash. And we said we were going to start returning cash in 2023. And why 2023? It's kind of when we've got to the point of that doubling, close to doubling of production. That's when we have spent the capital expenditure to take it there. That's when we have de-risked the projects, and that's when we feel comfortable from a cash perspective that we have full visibility on our position. And that was a statement we made when oil was $50 a barrel. So oil's at 75 now. Let's hope that that continues. And what that does is it has changed our wording a little bit, as you picked up. We said we're going to pay a dividend in 2023. We've now said within 2 years, but we said that back in August. So what we're trying to communicate is we're giving ourselves the chance, the flexibility, if we see our projects de-risking in time, if we see going into next year, the oil prices staying strong, the flexibility to bring forward the timing of that dividend, because we're all shareholders ourselves. Our chairman is one of the largest shareholders of the company. Everybody in the company would love to see a dividend as well. It's cash to us. We're shareholders. So we're entirely aligned with shareholders. We want to give that dividend as soon as practically possible. I think we need to see a little de-risking in the project, just making sure the oil prices stay where they are, and we'll take a view of that in the coming months. But we're hoping that that's the case.
Then I think at least the last question from me is quite short. When do you expect that you will be able to announce further M&A deals? It's been some good deals last couple of years. How is that market looking now?
Well, I tell you, we love doing deals, and you know, without boasting, I think we're quite good at it. We've demonstrated that. We've done many deals since the current team's been in. We're good at it. I think we're able to identify the right opportunities. You know, it's a technical analysis first, and then it becomes a financial analysis. Does it make sense for the shareholders? And we found obviously a couple deals that do. This one in particular recently really does. So it's just about being patient and trying to find those right opportunities. We're always going to be looking to do deals, but we don't want to disrupt what we think is a fantastic organic story at the moment. We don't want to do anything that changes that story or confuses that story. So anything that we do is going to have to make a lot of sense for our shareholders and for continuing on that dividend paying mission that we're on. So we're always looking, but we're not going to be greedy or too fast, or we have to be patient and wait for the right one to come.
Sounds like a good plan.
Thank you.
Many thanks to John Hamilton and Tom Erik Christiansen. And thank you for
watching.
Please keep posted.
Thank you very much.